So having finished the brief presentations of each speaker, we will now move to the question part of the panel. So I will ask each panelist a specific question. The panelist, of course, answers, but then the other panelists, please feel free to contribute to the discussion. So just to keep the same order of the presentations, let me start with Johannes. So Johannes, to what extent do you think that the financial regulator should include climate change risk in its models and estimations? Like, for example, when implementing stress tests for banks. Then, could failure to do so affect the stability of the financial market? Those are more general questions. And then a more specific one, Johannes, what do you think are the specific challenges for the financial regulator in Chile, which is a natural resource-based economy?
Thank you. No, these are very good questions. I mean, I think the answer is obviously yes to the, should it be included? Now, I think, there has to be a willingness to be open to the conclusions, right? So just because we're trying to study whether or not climate risk potentially affects financial stability doesn't mean that at the end of that process we have to find that yes, it does, and therefore, we have to do something about it, make capital adjustments, etc., at banks. But I honestly think we're sufficiently early in the process. This is a risk that no one fully understands yet. No one fully understands the implications. No one, because of all these measurement challenges that we've seen in Robert's presentation. It's very hard to look at your portfolio, know how you're exposed to these risks. And so there's obviously a potential for a financial stability risk in there. And so it's only prudent to think about that risk carefully and try and understand how big of a risk it is. And I think even people who currently think that at the end of that process you might actually realize that it's not as big of a risk compared to some of the other risks that you guys worry about. It's still a healthy process to arrive there. So I don't think we have enough information for anyone right now to confidently either state that climate change is a financial stability risk, or to confidently state that it's not. And therefore, we need to study it and we need to think through stress tests. And at the end of that, we know how bad of a risk it is. From the perspective of the Chilean economy,
Johannes,
yeah,
just to follow up.
Yes.
So as bank regulators, we are very worried about credit risk, of course. That's one of the main risks faced by banks. Should we think about climate risk as a subset of credit risk, or should we think of climate risk something like above and beyond credit risk?
I mean, from a purely, banking regulation perspective, right? What you worry about is financial stability implications, and I think a lot of those will come through credit risk, right? But I do think it is plausible that, and here we come back to your other question about the Chilean economy, that, a number of the particularly capital-intensive firms are in that natural resource sector. They probably have a lot of outstanding bank loans, and depending on which parts of the natural resources economy you're in, you might have substantial transition risks, right? And and if you can't sell your product anymore, then these huge capex projects that are bank loan financed, you might start running into difficulties repaying. So I think there's a very clear channel from the transition risk to firms to their ability to repay their bank loans. And so I think my sense is it is from a lot of perspectives, it's a risk like many others, and the way that it would affect financial stability works through some of the very same channels, credit risk, as you mentioned. There's maybe some ways in which it is, in which it is maybe more systemic fundamentally, in the sense that, it doesn't just affect firms, but it also affects households, and it also, and through affecting households, it affects government tax revenues and all of these other things. And so, but from the perspective of a financial regulator, I would try and figure out how it affects, how all of these things feed back into credit risk, which, I think is kind of the first order direction when you're trying to understand financial stability.
Perfect. Very clear. Thank you, Johannes. Rob, Eric, is there something you would like to add to this discussion?
Probably Johannes and Robert don't know that in my previous life I was the chairman of the banking regulatory agency in Chile. So I had some experience regarding this type of discussion, and we, for instance, we met, I don't know, every quarter with the Basel Committee and tried to come up with some ideas regarding that. And what I see, for instance, in the discussion regarding advanced economies and emerging market economies, that there is some divergence in terms of this type of discussion. And because it could affect the provisioning process for the banking system, it could affect the delivery of lending from banks, and it could be most costly in those cases. So I think we need to try to the balance in terms of having more evidence. So in that case, I agree with Johannes in terms of doing the stress tests in terms of getting more information, and then trying to assess what type of impact do we have, and have a plan. I think we should have a plan in terms of a transition period and how to implement this, because in some cases you can implement this type of regulation suddenly, but the impact could be huge in terms of economic activity. So you don't want to damage that. So you want to try to find this balance.
Perfect. Rob, anything to add?
Not to that, no.
Perfect. Thank you very much to all. So let's now move to Rob's question. It has two parts, a more general one and then a more specific one. So the more general one is, what do you think is the role of the financial system in the transformation towards a more sustainable economy? That's the general part. The more specific part is the financial regulator of Chile, which is the Financial Market Commission, is about to publish a new regulation that requires disclosure of ESG information for listed firms. How useful do you think this type of regulation is for the transition towards a low carbon economy?
Thank you, Mauricio. So it's a pleasure to take those questions. So I think the answer, at least to me, is very clear. The role of the financial system is absolutely critical. And it's critical in a few ways. So first, I think it's fair to say that, and I know many of the people here may be looking at it from a financial stability standpoint, but we have to think about financial systems and financial markets and why they exist. And they're really meant to empower transitions, right? I mean, transitions in industries going from one technology to another and advancing, and that process of creative destruction is really important for financial systems to be able to weather. That's why they exist. And I think the challenge is, if we only look at it from a financial stability standpoint, we may be missing an important part of the story. And that important part of the story is these are about climate risks and climate opportunities. And climate transition brings enormous opportunities as well. And frankly, OECD has been writing a lot about that over the past decade, about the creation of new industries, new products, new jobs that come along with this important transition that can help make growth more sustainable and climate resilient, and it improves the well-being for society. So that's a really important starting point, that we need to make sure we understand that for regulators and supervisors, that it should be not just microprudential or macroprudential, but really getting to the overall goal of what governments need to do to serve societies to make sure this is an impactful and smooth transition. So then the second issue is, I just said the term smooth. This is important to make sure it's orderly. And that's where I think that supervisors and regulators also have an important role to play. Of course, getting the climate pricing right and dealing with the externalities soon is going to be important to help this gradual and smooth transition. But another thing too is to make sure, with a bit of concern, I've been engaged with international organizations focused on the risks and the financial stability risks of the transition. I think it's important that we think about the net impact, because if the net impact is positive, we have to make sure we're not starving so-called brown companies from capital. the largest carbon emitters need the most amount of capital in concept to be able to make that transition. And if we take that capital away from them, they'll have stranded assets, maybe they will default, but they won't be able to make that transition. And I think we need to be really careful for that. And then the final point I'll make on that topic is, where do we find, also for supervisors and regulators, where do we find the current concern? If I were in the shoes of supervisors, I would say, I care about traditional finance, I care about credit losses, I care about business cycles in that regard. Where does that interact with climate that makes me really concerned? And I would look in the $2.3 trillion leveraged loan area, because many of the leveraged loans also have climate transition risk. And if you do a stress testing on that, you may find that leveraged loan holdings, CLOs, funds that are holding leveraged loans or high yield debt could also be subject to not just liquidity and credit risk, but also this additional wave of what would happen if stranded assets were to fall on those. And then you could have further contagion from those funds and interconnectedness. So those would be those areas. Now, for your second question, I really commend Chilean authorities for moving ahead and making ESG disclosure mandatory. What I really love about this ESG movement is there's no differentiation between advanced and emerging market economies. In emerging markets, you can become a global leader in what you do by moving ahead. And my own, if I could give personal advice, is the disclosures are the first part of the journey, but then as you uncover the massive amount of data you're going to receive, then it's trying to make sense of it and make sure that the information is comparable so that end investors, whether they're individual or institutional, can make sound decisions. And that's really the ultimate goal for markets, to allow these investors to make sound decisions, and hopefully they will be aligning it with climate transition, and then you're really on the right track.
Absolutely. Thank you, Robert. And that poses a huge challenge for us as a supervisor, because we have quite a lot of experience in supervising, collecting, understanding financial data, financial statements, balance sheets, etc. But we do not have, to be honest, the same abilities or skills to understand the non-financial data, including the ESG data. So we're going to have to do on-the-job training for our teams, and so we can move, just like you said, to the second step, not only receiving the information, but also trying to make sense of it. And one other thing I would like to add, Robert, I loved what you said about not only focusing on risks, but also on opportunities. And the way our regulation is written is precisely that way. So firms are going to have to disclose how climate risk produces both risks and opportunities for the firm, and how the firm would mitigate the risk and how it plans to take advantage of the opportunities. So that's exactly the way we're thinking. So I'm glad that you said that. Thank you, Rob. Johannes or Eric, anything to add to Rob's answer?
One thing that I thought was really interesting that you gave in your response that also struck me in your presentation was this idea, we have these brown firms, the dirty firms, and we don't want to take capital away from them at the precise moment when they may want to transition out of this, because that transition is expensive. And that kind of brought me back in your presentation. You talked about the importance of these ESG measures being forward-looking, which is, you might have two, fully integrated oil majors, one of whom wants to transition away, the other one does not. Based on current emissions, they might look equally bad, but because this forward-looking aspect, they're different. And you were saying as well, we should recognize that in the ESG scores, but we should also be careful to not pull capital from that who wants to change. And I wanted to kind of follow up and figure out, have you guys at the OECD thought about sort of commitment issues here? I mean, it's very easy, right now there's a lot of pressure. It's very easy to say, well, we will transition at some point. This is not just at the firm level, you have the same at the country, right? Every country promises to be net zero by some time in the future. And I've always wondered, if is there any enforcement? And, a lot of these, and so have you thought about what to do there? I mean, you might think, well, you have to not just give a target of where you want to be 20 years from now, but a clear path on how to get there with sort of, a carrots and sticks for, exceeding or failing that. Like, what do you do there? Because it's obviously important. The forward-looking part is important. And if you don't have it, you're going to have exactly that problem that oil companies that want to change are going to be starved of capital. But on the flip side, what do you do that is not just cheap talk?
I would love to be able to respond if time is permitted.
Yes, please, Rob, please.
Excellent. So Johannes, thank you so much for that question. This is what we're thinking about night and day, and we're actually in the process of developing climate transition principles, hopefully for the G20 next year, if they will accept it. And we're working with our committee right now to try and do this. So many years ago, I was an investor relations consultant in the United States. Quarterly earnings are as embedded in US financial culture as anything, quarterly earnings. And so when I hear these net transition plans where they have a goal for 2050 and an interim target of 2030, I'm sorry, but most CEOs should not expect that they're going to be in office in 2030. I want people to make commitments that they're in control of and that they're accountable to. So I'm not saying we need quarterly updates, but what we're talking about is really science-based targets, science-based interim targets, and annual reporting against strategies that make not just about the climate intensity, but what you need to do with your operations, what you need to change in your products, your revenues, your R&D, your investment, all of these things, so that investors can really judge if these plans are actually bearing fruit. And I think at the very least that there should be some sort of annual update that's in parallel with annual reporting. I know that could end up being a huge burden, but once TCFD is really, enshrined or we have minimum global standards through the IFRS, which should happen within a year to 2 years, I think regulators will be in a much better position to take that and really ask firms to start doing that. And we should hold firms accountable just the way we have been doing for financial earnings. We should be doing that for climate performance as well. And for engagement strategies with asset managers, if they're telling the world they have the engagement strategy and they care about climate, they should be very specific about the consequences. If a firm doesn't meet its targets within 3 years, do you pull capital away at that point? I'm not saying we starve firms of capital, but there should be consequences for not sticking to their promises.
Thank you, Rob. Eric?
Yeah, Mauricio, let me add some ideas regarding this discussion. I'm probably using two concepts. One is incentives, and the other one is transition. Because trying to build in this case regarding sustainable investment, I talked to governments, I talked to pension funds, trying to convince them to move towards sustainable investments, and everybody's reaction is, this is a great idea, I love the idea, but not yet. And it's interesting because in the case of pension funds, you can say, you know what, it's very complex to sell bonds and equity within the country because it could have an impact in terms of capital markets. And that's a fair, I would say, idea. But in the case of governments, for instance, when you think about sovereign wealth funds, everything is invested abroad. At least in a couple of countries, including Chile, there are no domestic investments. So in that case, it should be much easier to move towards sustainable investments without hurting returns. And it's going to be a really good example in terms of creating incentives for the rest of the industries, including pension funds. And I think that's an important, I would say, example or in how to do things. And I would say pension funds, even with this evidence that I show, I can say, you know what, I would like to prefer to have a different fund with sustainable investments, and I would like to have the choice to say, okay, I would like to have the fund, let's say C prime or A prime, where only there are sustainable investments. And even in this case, we can see that you can have a fiduciary case because in some periods of time, you can find higher returns if you invest in a sustainable way. So I think the discussion is open, but there are some examples that you can do in terms of creating the right incentives to move to more sustainable investments.
Very good. Thank you, Eric. And now let me move to the question I prepared for you, which has two parts. The first has to do with, it's related to your talk. So the question is the following. The pension regulator of Chile recently published a regulation that requires pension fund managers to include ESG criteria in their investment policies and processes. How useful is this type of regulation to move towards a more sustainable economy? So that's a question that I had from the asset side, but I also have a question from the debt side, because the development of the market for green bonds in Chile and other countries in Latin America has been much slower than in other countries around the world. So the question is, what measures could financial regulators implement in Chile and Latin America and the Caribbean to provide a boost in the green bond capital market?
Perfect. Thank you, Mauricio, for those questions. And I think the discussion is also related to my previous comment. And I think what the pension fund superintendency is trying to do, I think is an important first step, trying to consider climate risk and other risk associated with ESG factor as relevant financial risk. But it's interesting because it's telling the companies to say, you know what, you have to take care in your financial considerations, the impact on the environment, the impact on social issues, the impact on governance, the impact on not being corrupt, the impact on gender gaps, and so on. Is something like it's obvious for me. So at the end of the process, you're going to end up with a corner solution where all companies should be certified as ESG because the society requires that. So this is important in terms of sending the message that they should consider those type of risk, but I think that's not enough. And we need to create the right incentives to move in a quicker way to more sustainable societies. And that's why when we talk about inclusive and sustainable growth post-pandemic, we have to think seriously about that. We cannot wait. And if we want to find a new normal, we should try to find a better normal. And that's why we need to create these incentives. And sometimes you create incentives using examples like government investments, or sometimes you can come up with some regulations that try to motivate in some way investors. And I think that's an important way to do it. One example of that, given my proposal, is to create a new fund for the pension fund where you can choose a sustainable fund. I would choose that. So for instance, I would say, okay, let's go for the fund A, which has the highest position to equities, but I prefer to have a fund A with sustainable investments. And you have the choice. Now we don't have the choice as workers, at least in Chile. So that's one idea in terms of creating the right incentives to move along in this line. And regarding debt, I think also it's a process. I think important that governments are committed to issue more green bonds for a sustainable recovery. I think the big investment that we have to do on the public side is related to infrastructure. So we need to think about green infrastructure, and that's an important plan for any country. Also, multilaterals, I think they can play a huge role in terms of the impact on green bonds issuance. And I think that's an important that not only the IDB is very active in this market, but I think we have to join forces with other multilaterals that have a focus in Latin America, at least from our perspective. And of course, the private sector have to have those examples, and probably you can think about joint ventures in terms of trying to have more forces to move those changes in a further way, but also in a quicker way.
Very good. Thank you, Eric. So we're very good on time. So now we have around 15 minutes for a Q&A. with all the participants of this seminar. So I'm not sure technically how this works. Should the audience, should they already be sending their questions in the bar of the WebEx, because I cannot read it? Or maybe if they can do it out loud by talking. So this is a question for the organizers, if they can help me.
Yes, Mauricio. We'll wait some time for questions from the audience on the bar, and if possible, we'll also let them talk. I would like to pose the first question to the panel, which is, for many households and firms, there is this huge asset which is non-tradable, which is real estate, whether homes or land. And many cities are coastal cities, and they are subject to climate change from sea level rise. And I would like to ask, how can companies and firms prepare and hedge against this kind of climate risk?
I mean, I can give it a go. I mean, it's very hard, right? I mean, in some ways, exactly as you say, real estate is tied to location more than almost any other assets are, the value of it. And so, I mean, in the end, there's certain types of mitigations you can do. So people are talking about building seawalls, etc., to protect the value of existing physical capital in certain places. But honestly, these seawalls are going to end up being so expensive that there's only going to be very few places with the concentration of capital that it's worth protecting through a seawall. As difficult as it is, I don't really see an alternative over sort of this is more like a decade-long horizon of relocation. I mean, in some place there are going to be parts of coastal Florida that even with the amount of climate change that we've already baked in, like even if we stopped emitting carbon tomorrow entirely, the temperatures will keep increasing, and under very plausible physical models of the world, there are going to be places that will be flooded 30, 40 years from now. And so I think part of the idea is that as the capital stock gets rebuilt, there's depreciation, that we don't keep rebuilding in these places, because it's just very hard to imagine what else would happen there. And that's very difficult in some sense, right? Because you're telling people who have a home there, who live there, that but I also just don't see how we're going to get away from that if we're not honest. And I think one of the things you're seeing in the US right now is that until now, the federal flood insurance program, National Flood Insurance Program, heavily subsidized people building in these places. In some sense, that this wasn't something that was heavily priced, and that is going to change, or at least there's pretty advanced proposals to have that changed. That will mean that in some parts of Florida, your annual flood insurance premium will be way over $10,000, which makes it impossible to live for a lot of people there. But in some sense, maybe that is the point. Maybe the point is, price signals can be very effective. And if we cross-subsidize and not have the price signals there, that doesn't by itself stop climate change. It just means people will keep moving there, will keep building there. But just because the cost of the eventual damages is eventually being borne by the taxpayer doesn't mean there are no costs. And so I think a more honest discussion about what are sort of feasible, what will happen even if we have sort of a strong transition path, and sort of on areas like rising sea levels, what we've already baked in, and being honest about that some communities, it will just be very difficult to live there 50 years from now. I just don't see a path around that. And then we kind of come back. One of you, I think it was Robert, mentioned orderly transition, right? If we're honest and aware of that today, a lot of that can be orderly, and it doesn't have to be people who live there now have to move somewhere else, but no one moves there anymore. and it can be, but if we keep subsidizing and we keep pretending this isn't happening, it'll be much more disorderly and I think much more costly, both financially, but also in terms of social costs.
Eric, Rob, anything to add?
Rob, go ahead.
Sure, I would add that. So I agree with Johannes. This is a real challenge. I guess a lot of our work has been done for corporates, and there the transition can be truly orderly because in many cases, what's on your balance sheet actually depreciates. So as long as you have a depreciation schedule, and maybe it's an accelerated depreciation schedule, and you're reinvesting into renewables, whether it's or you're using renewables in your processes, it can be orderly. I think the challenge with homes, if you expect your home has value for decades to come, and you're expecting a sale price on that in decades to come, perhaps, and you're forced to leave your home because of flooding, and you're not able to sell it because it truly has lost its value, that's a real concern for society. And I agree with this point that trying to get insurance on the coastal areas is becoming more and more expensive as we're seeing events, actual physical risk events happen, and that's only going to get worse. And these are real issues now that are being discussed, so it's really healthy. I think the challenge, though, is, and we're seeing it, in France with the Gilets jaunes, that really is a climate transition revolt, so to speak. The just transition is one that's being talked about now by policymakers, and I think a lot more thought needs to go into exactly what we mean. Its externalities have not been addressed for decades, and now they're being socialized. But the taxing of that and how that's distributed to society, to middle and lower class, who are going to be forced out of these coastal cities, is a real political problem that will need to be dealt with in years to come. It's a big challenge.
Eric?
Probably I can add just like the big picture of this issue is like we need global governance in terms of how to deal with climate change. It's very difficult, for instance, for the Caribbean countries to do something in that regard because, of course, it's going to be costly. And probably with new buildings, you can have building restrictions, some regulations, and so on. But it's impossible for small islands and smaller countries to do something on that regard. At least in the short term. And that's why we need this global commitment in terms of implementing the Paris Accord as soon as possible. And I think that would have a positive impact on the society in general, and of course, the question that it was raised by Carlos.
Perfect. Thank you very much. And it's a great question, Carlos, because in Chile we have a lot of coast, more than 4,000 kilometers from north to south. So this is a very practical problem for us. So it's great to hear your views about it. More questions, please.
I have a question. My name is Alejandra Insunza. I work at the Central Bank. And a lot of you talked about corporates being really interested in these topics and wanting to incorporate them in their, I don't know, lives, but they set these sort of crazy deadlines and don't really do anything about it, like in the short term. So how do you think, or do you think it's important to bring these topics to the public so they engage in them, so they push for these changes? Because right now I see that, I don't know, like the young people are really interested, but it seems as waves, like older people don't care or other investors don't care. So how can we bring these topics to the population in an orderly manner so they are more active in asking for these changes with data, not just their feelings? Like, I'm not going to drink Starbucks because of the cups. That's a feeling, but not really understanding the problem itself. So how can we do that? Thank you.
I can start with some thoughts. I mean, one thing that I thought was kind of quite reassuring is that when in the survey we ran, when we asked the private sector participants, what do they think are the most effective pressure forces. I mean, it was institutional investors on the one hand, and then it was their customers on the other hand. So I do get the sense that, that this sort of preference that you feel, in people around you, that does manage to translate into behavioral changes. And, I think Eric was right in some sense in saying, look, it's not going to be solved by not eating meat anymore. But I have two friends who've turned vegetarian because of the carbon impact of it, and they make me feel bad every time I order a steak or a burger, and I'm with you. It's probably too small of an effect, but you do see that pressure, and hopefully firms get that pressure that way. I want to kind of respond by actually having a question that I wanted to ask both Eric and Robert, following on from that. If you kind of talked about how the investors put pressure, and both of you had kind of talked in a way that suggested that you thought this reallocation of capital was a big way in which investors could pressure these firms, right? So you make it more expensive to raise capital for, the brown firms, etc. I started to become more skeptical over the last months about the effectiveness of that, trying to kind of think through various models, etc., about how large of an effect on the cost of capital this truly has, and whether or not it wouldn't be much more effective to keep holding these companies, but actually put pressure on them as shareholders, the same way that some of these activists, proposed an alternative board slate for Exxon, right? It's probably more effective to say we're going to put on a board that will force the CEO to change, rather than I'm going to sell my Exxon shares, because almost by definition, the person I'll be selling it to cares less about the climate than I do. And so they'll put less pressure on the management, etc. So just kind of in terms of these various pressure players, how do you view the trade-off there? I guess it's called the exit versus the voice,
I get to answer that?
Yes. I'm just going to decide yes.
So first to Alejandra's point. So it's a very good point, and I guess there are various means that companies can get these messages out to broader society. To the extent that people read annual reports, I mean, some are actually really insightful and worth reading. I think climate transition reports are coming out now, and some of the climate transition reports that align with TCFD reporting are really quite good. They blend a narrative of strategy with some data. Our point is to make the data and the commitments based science-based targets, clear data, comparable metrics, good scenario planning, and that way people of different levels of education can understand it. If you're assessing climate at a central bank, you're going to love this because you can analyze it across companies and it will make sense. I do notice that, for instance, auto companies, when they market that they're committing to net zero, they're marketing it also to their customers. So the buyers of autos also know, okay, this company has a net zero commitment. I want to buy electric cars or hybrid from that company. This is all very useful. However, to really make it legitimate, you need third-party verification. You need to name and shame. You need another body that's credible, that's reviewing these companies and labeling which ones are really achieving their commitments and which ones are not. That's the best that and of course, then politicians get involved in that and they review it. In the US, you can have committees hold some of these company leaderships responsible. But if you really want to hit them where it hurts, it's compensation. So and this gets actually to Johannes's point too, if compensation is still stock-based, you're right, Johannes, you're right. I mean, the cost of capital, it's not going to move around that much until you exclude them from your portfolios, like coal is really getting hit. But for the big oil companies right now, it's not going to have too much of an effect on their cost of capital yet. But if you were to embed the achieving of the targets into their compensation, just the way financials are, that might be a way to start scaring CEOs to know that it will really affect their compensation and their reputation, both if they're not achieving these results. And it also hurts your future to jump to other companies. This is a personal view. It's not necessarily an OECD view as far as I know, but just I really think that when you get to the heart of it, if you want to change behavior, change the incentives.
I completely agree with Rob on that in terms that we need to change the incentives to get some change in behavior. And I have to say to Johannes that Chileans, we love to eat meat and we love to organize barbecues and so on. So it's very complex to go that path. That's why I'm trying to convince you that we need to move to sustainable investments to make that change. And the question by Alejandro is very important. It's very specific, but I think it touches a lot of issues related to my presentation regarding how to build this business case in terms of sustainable investments. And if you want to see like the big picture again, is this discussion regarding shareholder capitalism vis-a-vis stakeholder capitalism. And I think it's important because sometimes investors have their own preferences. And if I ask you guys, probably you would like to say, I really like to close the gender gaps in companies and in the society. We have to fight against corruption, and we have to have a stronger governance in companies and so on. And sometimes these preferences are not reflected in the board discussion of companies. And we need to change that. And we have to give price and value to that type of discussion regarding sustainable actions. And that's why the government and the regulator play a really fundamental aspect in terms of changing the incentives, as Rob pointed out. And this means that they need to have a little bit of courage to say, okay, probably we need to create a new sustainable fund, and we allow that pension funds should invest in this type of investments because consumers and society are looking forward to do that. And probably, Alejandra, you're going to invest in a sustainable fund, and the discussion will be, are you willing to lose returns? And with the evidence that we have, I'm telling you, you're not losing returns. You're investing in a better way. That's it.
Dear all, there's more questions from the chat, but unfortunately, we're out of time.
Mauricio, we'll read a couple of questions from the audience.
Yes, please. But we don't expect an answer because we have to finish right now.
Okay, so Álvaro González asked a question to the panel regarding the inconsistency among the ESG rating agencies, scores, and methodologies, and the effects over portfolio composition. And to the panel, it says, do you see this as a problem for good allocation of investments and incentives to invest in companies? And is there space for policy making in this issue? And then another question regarding the graduality and boldness of the measures. It says, can you think of bolder measures that do not necessarily rely on market players' slow adaptation to climate risks? So if we can maybe use a couple more minutes to answer those questions.
Carlos, you let me know. I'm a regulator, so I'm an enforcer. So my time is out.
5 minutes and we are out. Yes.
Okay. So if please feel free to give your thoughts on any of these two questions in these 5 minutes. Thank you.
I mean, I think I'm going to start. I'm taking the first one. I'll leave the difficult one with the bold action to the to the other panelists. So I'll take the easier one on. I mean, I think this is exactly the case. I think having these inconsistent and contradictory ESG ratings makes it very hard, right? I mean, we just had the question from Alejandra on what can people do to pressure firms, and like one of the things could be you just don't hold their stocks, you exclude them. But if you have no good way as a retail investor to actually tell which are the green firms and which are the dirty firms, it's very, very hard to do. And so, people might end up buying these ESG funds, think that they've kind of done something, and then when you unpackage them, they still hold, carbon heavy firms. So I think that's exactly, a strong problem in terms of this, allocation of capital. Yes, absolutely. And so now the difficult questions to the others.
I'll jump on that as well and be just very brief in saying, yeah, I mean, a lot of our research over the past few years is talking about the inconsistency, the lack of comparability. It sounds technical, but it's really, for markets, it's really a big deal. if you get your financial reporting wrong, you could go to jail as a CFO. There's serious issues. And the fact that you can blatantly get the ESG reporting wrong and there are no consequences, I think it's a big issue. It undermines the ability of investors to make decisions to put their capital where they think it will have an effect. And if they want to put it towards sustainability and climate, they should have the right information to choose among firms. It's super important. And then the second issue, are there things we can do outside of financial markets? I focus on markets, so anything outside of it would just be my personal opinion. But my personal opinion is, yeah, there are certain things you can do. The OECD is leading efforts to try and affect carbon pricing. I think if you get the carbon pricing right and you rid the externalities, then I think markets and business decisions will find that renewables are actually more affordable, and you'll get an acceleration of the climate transition. So let's hope for that. And then the second issue is, again, this is completely personal, but of course, you know, we're allowing companies to say net zero 2050. If you wanted to accelerate the transition, maybe certain governments could try and push those dates up a little bit further, or have the pathways be different. That's something I wouldn't get into, but I think there are other levers than using the markets, or in addition to the markets. Thanks.